Good afternoon. This is Kathy Neifeld, one of the four partners at Agency One. Together with Ed Lesher, Dennis Bartos, and Gonzalo Garcia, I am honored to welcome you to the 2020 Agency One Annual Advisor Conference. This is day 4 of the Agency One Virtual Advisors Conference, and we still have 3 more weeks of phenomenal speakers and content to share with you. We hope that you have registered and will attend the upcoming sessions. Thank you for joining us. Earlier today, we heard from Tim Arnold with StoryBrand on how to implement 7 easy steps to clarify your message so that customers will listen. If you missed that session or any of the sessions from last week, they have all been recorded and are available to you on the CVent site through the Attendee Hub. This afternoon, my partner, and more importantly, my friend, Gonzalo Garcia, is going to take the lead and conduct a workshop on changes that have taken place in the charitable planning space with life insurance and a new underwriting approach that is being utilized. Just a couple of housekeeping items before I turn this over to Gonzalo. All attendees will be on mute, and we would appreciate it if you would remain on mute throughout the session. You could submit questions through the chat function. Most of the sessions will be recorded, and a link to the recording will be made available after the session. And please don't forget to complete the session survey after the session. Again, I would like to thank you all for being here today. And now I'm going to turn this over to Gonzalo.
Thank you, Kathy. I hope everybody can hear me, and good afternoon. I'm really excited to present this because this is something we have been actually using from back in 2016, maybe early 17, and it really hasn't gotten enough visibility and press. And it's really about helping the nonprofits create sustainability for their cause and mission. And for those of you that know me, I'm very involved in charitable endeavors, and probably because my wife works for one, so that's kind of my life. But this is something that we've been very passionate about for many years. And you know, before we really get going, is what I would like to tell you is what this program isn't, what it really is, and you know, kind of let you guys walk away with how it works. But before we get into that, there's, you know, for those of you that have been around the business and have just even a little bit of memory, you know that there's this big white elephant in the room. And, you know, the news about insurance has not always been good. In fact, in an article, and this dates back to 2008, in Charitable Gifts of Life Insurance, you know, pretty much all the news 10 years, 12 years ago was bad. And some of you may recall a number of schemes and other programs that were out there, but you know, from vanishing premium, leaving charities with empty bags, to charitable reverse split dollar, some of you will remember that. Insurance in the charitable space really became kind of the black sheep of planned giving vehicles. And you know, that really has to do with a number of things that were going on then. For those of you that remember charitable split dollar, you can see at the bottom of the screen, promoters of these transactions and taxpayers and organizations participating in them may be subject to adverse tax consequences, including penalties. You know, the IRS did not smile kindly on charitable split dollar. And as a result, a lot of the taxpayers, including charities that got themselves involved in that transaction, ended up, you know, a lot of charities ended up, you know, holding an empty bag. And a lot of people with taken deductions lost their deductions. So, you know, this dates back to 1999. You know, more recently, for those of you that may remember the Oklahoma State University thing with T-Bone Pickens, where, you know, there was an awful lot of, ended up being what they call CHOLI, charitable and life insurance, in a financed transaction. And T-Bone Pickens was financing the transaction for the Oklahoma State University to buy insurance on a lot of the people that were involved in Oklahoma State, certainly with their athletic department. And this got terrible press, and one of the companies that was involved ended up having just all sorts of chargebacks and reversals and so on and so forth. So really kind of a bad result. And charity after charity continued to have situations like this come up. and really did not leave the NGO or the non-governmental organization world or the charitable world really too excited about talking about life insurance. And I think we're kind of emerging from that and have emerged from that over the last several years. And I think this is a great opportunity to talk about plan giving again. So, you know, again, from the Plan Giving Design Center, you know, life insurance is a great tool for providing an amplified gift on an installment plan. And I think there's more and more people, as you'll see as we go through this presentation, that are thinking that the ability to make a plan gift to charity today is as good as it's ever been. And we're going to spend some time with that. The issue is, can we get the charities past a lot of the kind of sour taste in their mouth that they had from charitable versus split dollar and some of the premium finance schemes that were out there, you know, 8, 10, 12 years ago. So we're kind of still dealing with that. And there's a lot of insurance companies, as you'll see, that really don't want to have anything to do with charitable and life insurance. Or if they do, it is really very limited. So we're going to talk about that as well. Let me tell you what this presentation is not about. There is no financing. This is not a scheme. We're not talking about split dollar. There's no complex structures here. There's no empty bags for charities or, you know, this is not a shell game. And as I just discussed, the insurance industry has really hurt itself with a variety of problematic tax and financial schemes. So let's talk about what this is. This is an exclusive underwriting program that was designed in conjunction with Principal Financial Group and the organization that we're a part of, LifeMark Partners, to really expand charitable owned life opportunities. So let's talk about kind of how we got here. A number of years ago, about 4 or 5 years ago, LifeMark Partners, which is now Libra Insurance Partners with their merger with Bramco, got together with Principal and we started talking about, let's eliminate the issue of donative history. So for those of you that have done any kind of work in the charitable environment, what you know is that usually the insurance companies look at charitable owned life insurance as a financial loss in the event of a donor. Okay, so what does that mean? When you look at financial underwriting, they're looking almost as if it was key person or key donor insurance. And you know, if I've been giving money to a charity and I die, then those donations will likely end. So the insurance world has really looked at this as, what is the financial loss to the charitable organization in the event of a death of a donor? And what they came up with was some formulas, and we're going to get into that. Now, the thought process behind the development of this program was, and Principal, you know, was very enlightened when we got into this. There are millions of boomers and people that are into their 50s and 60s that are now in a situation where they have more disposable income. And the reality is that there's a lot of people that, you know, their kids are out of college, they finished paying the braces, maybe the daughter's already got married, you know, whatever it is that they were paying, their mortgages, et cetera, they're kind of at the end of that process. And they're finding themselves with more disposable income, and they're now just getting involved in a much more meaningful way with the charities of their choice. So, you know, think that, okay, you know, I was giving $1,000 or a couple $1,000 or $5,000 to my favorite charity, and then all of a sudden I've got $40,000 or $50,000 or $60,000 more of income because my child is now finished with college, or because my mortgage is now paid off, or whatever. So that was kind of the development of this. And what Principal realized is that the donative pattern of that particular charitable donor may not be what it will be going forward. And what they wanted to do was create an environment whereby people with interest in charity could make donations regardless of what their history had been. So let's kind of talk about how this works, right? So in effect, what you have here is you've got a charity and a donor and the insurance company. Those are the three parties. The donor is going to create, issue a policy or transfer an existing policy to a charity. The charity is going to be the owner. The donor is going to make annual gifts, which are deductible gifts to the charity. They retain no rights to the policy whatsoever, unlike in the split dollar agreement. The charity will pay the premiums to the insurance company, and at the time of death of the donor, they will receive the proceeds. That's basically it. That's really all you need to know in terms of how this thing is structured. But what you don't know is that, if you look at this individual, and we're just using consider, the sample donor who was making 10 years ago, was making $250,000 and had a $2 million net worth. And, for that 10-year period, he was finishing paying tuition, he was finishing paying off his mortgage, he may have had a child that got married, et cetera, et cetera. So the disposable income was not that meaningful. And if you look at the donative history, so $2,000 in year one, $750 in year two, $1,000, $750, and so on. And in that last year, so my kid graduated from college, I feel a little better now, I gave a $10,000 donation to XYZ charity. If you look at that fact pattern and you use the formulas that the insurance companies use today, what you would be able to issue on this individual, assuming the average donative history over the last 10 years, would be a $30,000 policy. Now, I'm sure there's nobody on this call that would get terribly excited about doing that. And frankly, I don't know that many charities that might be that excited either. We're using, just for argument purposes, a guaranteed product age 105, because we want to make the charity feel good that the premiums are paid. This thing is guaranteed for the life of the donor, right? So I talked about kind of the enlightened approach that Principal took on this. And what we're looking at here is, based on the new underwriting guidelines that Principal came out with, this donor could make a planned gift of up to $2.3 million for this particular charity. Now, it's not an all or nothing thing. Let me walk you through the formula, right? So what Principal decided in putting this program out there was that they would look at the income as reported on the financial statement or on the financial disclosure in an application. They would take the income and they would apply a formula of whatever face amount could be acquired with 10% of their current income. So in this case, you look down at the bottom here under income, it says $387,000. So I just took $38,000 to round it up, and $38,000 would buy $2.3 million of coverage, or 40% of their gross estate. So in this case, net worth is $3 million. That's 1.2 million. $38,000 buys 2.3 million. So it's the greater of the two. Okay. That, just want to make sure that everybody's clear on that. So it's the greater of 10% of current income for life, or 40% of the gross estate. Now, all of a sudden, if you go back to this one, under most of the insurance companies' financial underwriting guidelines for charitable and life insurance, let's just say they averaged the last 3 years, right? So you might be able to get $100,000 for a policy in terms of a planned gift. Now, remember that when you make a planned gift to a charity, the charity is generally very eager to announce that, Gonzalo Garcia made a donation of $2.3 million to XYZ University or XYZ church or synagogue or whatever. So, and for a donor, that is a big deal because, they get the press, they get the notoriety and all that kind of good stuff that comes with it. So when these plans are implemented, charities are very anxious and eager to say they made a gift. They don't say they made a gift 40 years from now. They made a gift. It's a planned gift. So there's a lot of reasons why donors want to do this. But we need to make sure that in our world, it is the difference between a $30,000 policy and $2.3 million policy is suddenly worth our time. And if you walk away with nothing from this session other than that, this is a viable business line that you can be in. I'm not suggesting that you go out and only do this, but we're going to talk a little bit about kind of some secondary sales and some other things that you can get involved in if this is of interest to you. So I think what's important here, and I had this conversation a number of times with Principal Underwriting, is that, well, what if I want to do a 10-pay? I don't want to make that commitment for life. I want to do a 10-pay or a 5-pay or a 15-pay. I'm 50 today and I want to make donations until I'm 65 or until I'm 60, because a lot of donors want to kind of do it, get it over with, and then have the policy be paid up, guaranteed. So what Principal allowed me to do was to present value the future premium streams and then discount them back to 10 years or 15 years. And so we have some formulas that work that way. So for example, in this case, on a 10 pay, we were able to make a donation as high as 70 or 80,000 for this $387,000 income person. So my point there is, while it's limited to 10% of income for life, we can present value those back and calculate a premium over a 10 or 15 or 5-year period that will meet some of the guidelines of the program. So that's really important. And again, I say that because a lot of donors and frankly, the charities want to know that this is done and paid for, you put it in the vault, and that planned gift comes at a later point in time, okay? By the way, for any of you who have questions, I mean, a lot of the sessions that we've been doing during this meeting have been kind of chatting the questions and whatever. Kathy, if you're there, feel free to interrupt me at any time to have questions, or just take yourself off of mute one at a time and just ask me the question and try to make the session a little bit more interactive than some of the other ones have been.
Gonzalo,
Yes.
you know I am always happy to interrupt you, and as soon as some questions come in,
okay,
we will address them.
Thank you, Kathy. All right, so one of the challenges for those of you that are involved in charities at all is that you probably know that the biggest problem for charitable organizations today is current cash flow needs. They're not, I mean, they love deferred gifts, but if you go on any website of any charity, you're going to see this donate now button and they want money today, right? So kind of how do you kind of get over that in the context of, again, this emerging younger boomer or even mid-boomer where they suddenly find themselves with more disposable income and they are inclined to make planned gifts. So one of the things that we started coming up with is, and this is kind of the example. So if you remember this slide, the person was 50 10 years ago. So now we're 60 years old, okay? And the income will continue to go up until normal retirement age, which I just assumed to be age 67. And, you know, it was that first year the kid finished college. Now I've got 50, 60, $70,000 extra income. And I want to make a charitable donation. And maybe what we can do here, and just in the example that we use, is, okay, what would it take to make a planned gift of $1 million to this charity and fund it over 10 years? And what we did here was, actually in this case, it was 8 years, right? So we did an 8 pay, 8 premiums, guaranteed $1 million to age 105. We got the donor to make a $40,000 annual gift, of which 27 was going to be used for charity, for the life insurance premiums. And the charity, who had gotten $10,000 in the year before, is now getting $13,000. So the charity wins because they got 30% more cash flow today for the next, 8 years. And then they also win because they get a planned gift at, paid up planned gift, if you will, at the end of 8 years. So it's kind of a little bit of a win-win situation. And you can take these numbers and manipulate them however you want. You want to do a 10 pay and get somebody to put in some more premium, give the charity a little bit more cash flow currently. So there's a lot of ways to have these conversations with the charities to make this attractive for both parties. Remember that what we're doing here is we're providing a $40,000 deduction to this donor. Okay, so for those people that are interested in making planned gifts to charity, who are looking for income tax deductions because all of a sudden they've got all this extra disposable income, this is a great way for them to not only make a planned gift, get a $40,000 deduction, but maybe get their name on a plaque or on a brick or on a bill, whatever that may be at XYZ charity for a $1 million gift as reported today based on the planned giving guidelines that we see from most charities. And where I think some of the opportunities are, and we call this the Columbo sale. It's just one more thing. I mean, as you all are doing estate planning or executive benefit planning, and you ask the questions about, do they have charitable intention? Do they have any kind of charitable inclination? Do they have a favorite charity? Have they ever thought of making a planned gift or making higher tax deductible gifts to that charity today. And again, when you find yourself in the situations where people have that much more disposable income because of the end of a big event, such as college tuition or paying off of a mortgage or something, then you've got something to talk about. And you can really leverage some of these gifts for endowing buildings, sustainable growth through planned giving. It really gives the charities a great leg up to continue their mission for years and years to come. And at the end of the day, while they really want income today, and we're trying to give them some of that income based on the additional donations that we're asking donors to do, we're also kind of furthering their endowment and giving them a much longer range view in terms of planned gifts. And that's really, really important to them. So let's talk about kind of how this works. And Principal created a kind of a requirement sheet, and we have it. We're happy to send it to anybody who requests it. We'll just go ahead and send you the document. But I broke the document down into 3 pages. One is kind of the financial information. The proposed insured should have already addressed their personal income and family needs prior to buying insurance. Remember that just like a life settlement or just like any other insurance, charitable life insurance takes up part of the insured's underwriting capacity, right? So there's only so much insurance that an individual can buy based on their financial wherewithal, net worth, income, and so on. So when you're talking about financial underwriting, Principal wanted to make sure that people had pretty much addressed their personal and family needs, both in income and retirement, before they launched into this program, okay? So their personal needs should have been satisfied, and they're going to ask you how much insurance is already in force on this individual. Second is they have to have, the discretionary income to do it. The worst thing that anybody can do with a charity is have somebody do a transaction like this, and in the second or third year, the donor says, you know what, I don't want to do this anymore. Because now the charity owns a policy that they either have to surrender or they have to lapse. And that's just a bad result for everybody. So you want to have somebody who's committed and has the income to follow through with this, which gets back to the issue of a lot of charities would rather see a 5-pay, a 7-pay, a 10-pay, get this paid up, get it guaranteed, and move on because they know it's in the bank, okay? And then they want to make sure that the proposed insured or the charitable donor has enough, adequate net worth to maintain their standard of living through retirement. So they're asking net worth questions, they're asking insurance in force questions, and they're asking income questions on these. So if you can't really kind of answer yes to these questions, you really don't have a client. So you can cut to the chase very quickly. Okay. Now, charitable connection. Here's kind of where the rubber hits the road, because if they've never made a gift to charity X, if I've never made a gift to my alma mater or to my church, or I don't give time or talent or am involved. So there's got to be some charitable connection with this organization. And that is pretty much covered. It's a pretty easy one to meet, because all you really need to do, or the donor needs to do, is just write some cover letter. You might say, look, I haven't made a gift to my university in 5 years because I was putting kids through college. I used to give them, $100 or $500 when they called me during their campaigns, and I needed to have them stop ringing the phone. So I'd give them a little bit of money, but I'm an alumni of this university. I love my university. I want to be supportive. I want to do a planned gift. And that's really all it takes from a cover letter standpoint, okay? And then you get back to the issue of the greater of 40% of net worth or 10% of income provided under the financial data sheet, which is part of the application, okay? Finally, it has to be a permanent product offered by Principal. The policy owner and the beneficiary has to be a qualified charity or nonprofit organization. The gift has to be made to the charity, and the charity has to remit the premiums. The reason you have to do that is that's the only way the donor can get a deduction. So charity owned, charity is the beneficiary, charity is the premium payer. Okay, we went through all the financial justification, we went through all the charitable intent on the previous slides, and then finally, the premium cannot be financed. So there is no premium financing in these transactions. again, I mean, when you think about what I talked about at the beginning of the presentation, it's fundamentally they're trying to avoid all the schemes and all the empty bags that the charities were left holding in prior transactions where a lot of the stuff just doesn't work. Kathy, you got something for me?
Yeah. So one of the questions that came in was, can you use second to die if premium is an issue?
That's a great question, and the answer is yes. We have actually used second to die in a number of situations. And the donor, let's say that my wife did. She went to a different university than I did. So, but let's say that we wanted to make a planned gift to her university. So that connection doesn't have to be there for both insured. So long as both of them agree that Georgetown University is going to get the gift, then Georgetown University it is. So second to die can be done. Again, that almost doubles the death benefit. The thing is the charitable organization may not get it until a little bit later because now you're bringing in two lives. So great question, and I'm glad you asked that, whoever that was, because I forgot to mention that. Anything else, Kathy?
Yeah. So there's definitely a distinction between having this conversation with the proposed insured in terms of their charitable planning versus having this conversation with the charity and saying, let's use this as a fundraising opportunity. Right. If we're going down that second route, what would be your recommendation on how to create some stickiness and get some traction with the charity? Because we've all seen presentations made that then just kind of go out into the cloud, so to speak, and nothing happens.
That's also a great point. I mean, look, I don't have a guaranteed answer for that, but here's what I would do. Do not start with people who are in the fundraising side, right? If you know somebody and they're a fundraiser for your university or for your synagogue or for your church or whatever that may be, you really want to start at the top. I will tell you that I don't know if they're on this session or not, but there are two advisors that have worked with a particular organization. It's a religious institution. I'm not at liberty to get into too much detail, but they now have well over 100 lives as part of an overall campaign. And Principal got behind this. Now, some of you may know that Principal has a division, if you will, where they do a lot of business-owned life insurance. So think deferred compensation, think key people, think all those kinds of things, where they'll do common billing, so list billing. They will do reporting back to the organization in a COLI environment or an employer-owned environment. So they agreed to actually put this program with these 100+ policies into their BMI platform, which is their administrative platform for businesses. So, when you get Principal behind this and you have somebody who's operating or working on a longer range funding campaign, whether it be for endowment or for other growth opportunities, they want to build a new dorm, they want to build a new building for, the science or, whatever that may be. We have seen some real success in some of these entities where they can get behind it. And the particular religious organization in this case was an organization that basically said, look, our members tithe, right? They give us X percent of their income. And we know that we have to set some dollars aside for the future. And what the religious organization decided to do was they were going to take a percentage of the tithing and use it towards insurance. It worked really well. I mean, some people are young, some people are old, some of them single life, some of them second to die. You have couples, you have children involved. So, I mean, this thing has worked really well for them, and it continues to build. So we routinely are getting applications coming through the process, and Principal's done a remarkable job at putting together all of the administrative process around it. So again, I don't know if I answered the question specifically, Kathy, but just like every other situation, when you want to do an executive benefit plan, you don't go to the HR people, right? You go to the CEO, CFO. So you kind of really want to be the C-suite level in these organizations if you really want to have any kind of success in doing this.
Thank you, Gonzalo. Another question that came in was, how do you handle objections to handling the administration of the policy by the not-for-profit?
Yep. Well, it kind of gets back to what I just said. If you're in a multi-life environment, when you're doing single life transactions, I mean, it's just like administering any other individual policy. The good news is that, if you're going to use a GUL or a survivorship guaranteed universal life, if you can make it so that it's a short pay environment, then, after 7, 8, 10, 15 years, whatever that may be, you're kind of done, you're paid for, and you're good, right? When you get into current assumption products, obviously you want to be modeling this stuff. And again, each carrier does, good job, bad job in administering in-force blocks. I think Principal does as good a job as any on in-force policy management. Now, with that said, if the charity says, oh, I have some policies with Principal and I have some policies with Nationwide and I have some policies with Prudential, I mean, Principal is not going to administer the policies for all the other companies. And you may have a portfolio of assets, in this case, life insurance, which the charity needs some help with. They're probably doing it already because they have a multitude of donors giving them, oh, I have this old policy, I don't need anymore. Here, let me give it to the church or the synagogue or whatever. And now they own this policy. Hopefully it's paid up, right? Because if they have to continue to make premiums and so on, they may not be that interested if they're not getting the donation from the donor to make those premium payments. So, again, if you're working with an organization and you have only Principal business, Principal is going to do a bang up job in administering that just as if it was an employer-owned block of business.
Terrific. Another question that came in, if you want to donate appreciated stock to the not-for-profit, can they be directed to sell or use that stock to buy life insurance with the donor making additional gifts to pay the premium?
Look, anything is possible. I mean, if you have an arrangement with a charitable organization and you're making a gift of appreciated stock or any other asset, can you force them to sell and buy insurance on them? I don't think you can force them to, but clearly if there's an arrangement whereby they will then buy insurance on your life and you will make additional donations, or they will use, the continuation of the income produced by that asset to pay for the insurance premiums, that's fine. Just at the time of issue, and I think this is the most important part, there has to be a charitable connection. We have to meet the financial underwriting guidelines. The charity has to be the owner, the beneficiary, and the premium payer of the policy. If you meet those guidelines, at least under this underwriting program, you're good.
We don't have any more questions.
Okay,
so...
great. Let me just wrap up here. And, I've said this now a multitude of times. Charity owned and charity paid creates a charitable deduction for the donor, plan gifts in the form of life insurance for the charity. Now, this program is an exclusive program between what is now Libra Insurance Partners, it used to be LifeMark, and the Principal. So it is a relatively smaller distribution in terms of access to the program. I think I can't say this enough, and I don't think I elaborated on this earlier, but if you think of that 15 times multiple on past historical giving, right, on donative, what we call donative history, unless you've got somebody who's making, $100,000 a year donations to XYZ charity, you're really not going to get into a face amount. So $100,000 a year on average, say last 3 to 5 years, is going to generate $1.5 million policy, right? You saw on a 59 or 60-year-old, this was generating at 10% of income up to $2.3 million. And that's really only because of the underwriting guidelines that Principal has come out with. I will tell you that there are some companies that will not do charitable and life insurance at all, period. There are those that will do it. Usually it's 15 times donative history. And there's one company who will do 20 times donative history, and they'll give credit to the donor for time. So if I'm doing 10 hours a week at the charity and I'm donating my time, they will include some of that as part of the financial justification. So just be mindful of those things if you're going to, stick your toe in this charitable life insurance pool. But I can't say this enough. Do it right. Don't try to make schemes. Don't try to create a situation where you're creating massive amounts of tax deduction for somebody and leave a very small amount to charity. It's not going to work. We've seen it happen time and again. You have another question, Kath?
I do, Gonzalo, and it really speaks to what you just said about folks that are donating their time in addition to what their financial picture looks like.
Right.
So the question that came in is, if the donor also has a deep history of involvement, such as a board member or chairing endowment investment committee,
Yep.
can that significantly add to the insurable capacity under this platform?
I would tell you that I don't know. I think I'm focused on the operative word being significant. It goes to a charitable connection, clearly, okay? It goes to time, so how much is your time worth? And some companies will give you a dollar allocation per hour, per week, per month, whatever that may be, in terms of the financial justification. But again, if you're gonna focus on the traditional way of doing things at 15 or 20x your donative history, then you're really limiting the amount of insurance you're gonna be able to buy for that charity. If you focus on 10% of what your income is or 40% of net worth, whichever is greater, then you're really expanding the amount of insurance you'll be able to develop for these charitable entities. And then time, because time and involvement or time and talent becomes much less of an involvement. That just goes to establishing the charitable connection. I hope that was clear.
I think that was, I can follow up with the gentleman that asked that question if there's further confusion. Another question that just came in was, I hear many of my clients are leaving their qualified plan to not-for-profits. I assume you can compare taking distributions and buying life insurance?
Yeah, I mean, you know, what's interesting about that is if I take $100,000 out of my IRA, that's $100,000 of taxable income. If I turn around and give that $100,000 to charity, that's a charitable deduction and it washes out, right? So the question is, you know, unless you're pre-59 and a half, but that's a whole other conversation. But, you know, if I can take that 100,000 and create a $5 million plan gift for charity, am I leveraging this as like any other use of insurance, right? Am I leveraging an installment payment to get a much larger gift for the charity? Or, you know, in estate planning cases or in trust cases or in anything else, I mean, you're fundamentally making installment payments on what is presumably going to be a larger payout in the future. So the answer is yes. Qualified plan money can come, it's got to come out of the plan. It's got to be included as income. You wash it out with a tax deduction for charity as a charitable gift. So long as the charity then is going to buy insurance on you and make those premium payments and you're committed to doing it over a period of time, then yeah, that could absolutely work.
And we don't have any further questions.
Good. Well, this was a workshop. We were not going to go a full hour, and I'm glad, you know, we got this on the table. For those of you that don't know me, if you need to get a hold of me and ask any additional questions, write this down. And Kathy, I turn it back over to you, and I just want to thank everybody for being on the call and for your interest.
Thank you, Gonzalo. Just a few reminders. Please remember to fill out your surveys. They will be emailed to you sometime this afternoon. Also, we hope that you will join us tomorrow at the virtual exhibit hall from 11 o'clock in the morning to 12 noon. And then at 12 o'clock noon, we have a not to be missed session with nationally recognized estate planning attorney, David York, on how you can help your clients build legacies that last. David will discuss, among other things, what is wrong with current estate planning and how it can be fixed. We hope that you will join us tomorrow. Thank you for your participation, and please reach out to Agency One if we can be of any assistance. That concludes the session for this afternoon.
Thank you, everybody.
Thank you.